The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, folks, I'm going to start out the show today. By the way, thank you for joining me, and I want to start out the show today with a couple of questions that people have brought to us from the den. The first one is on corn. I posted the chart of Christmas corn. That's December corn, and as you can see, we've pulled back to the 786 retracement of this whole move. We hit the 61% retracement at the highs. That was in July. If you remember, we had Rich Anderson from Anderson Capital Management on the show, and he was saying about the cyclical nature of corn to top in the July period, and it's certainly what happened, and it did it right at the 61% retracement of the high from 2014. Now, in just a matter of just a few weeks, we've pulled back to the 786 retracement. Whether it's a good buy here or not remains to be seen, but it certainly has a potential for a pretty good bounce. If we do get one. We've got a gap in there, but pretty much the corn crop has been made. The bean crop has not been completely made yet. That takes about a month between the 15th of July through the about the 20th of August. That's when it does the pollination for beans to get the little sweet little beans in the pod. There's usually 3 soybean in each one of the little pods, and when you get to 2 soybeans in a pod, you got a big problem, because then you got deficiencies in meal and oil, and prices go through the roof. That doesn't seem to be happening this year, so we want to watch that. So we'll keep an eye on the corn here. The other question that we've had is about the stock of Facebook. Now, we have a situation here where Facebook is going to give their earnings out today, and I'm going to put the long-term chart in here, and you'll be able to see that there's a huge ABCD from the time that Twitter made its low down around 16, and that ABCD measures to 112. That's up 15% from where we are now. Let me see, 10, yeah, around 15% from where we are now. So it's a possibility that we could get Facebook up 15%. Facebook now has more capitalization than Walmart, and I saw an interesting thing. 2 of the richest women in the world are both Walmart are Sam Walton's heirs, so they're in the $40 billion category, so just a little behind Bill Gates. You never hear of these folks. They're very philanthropic, which they should be, because once you have $1 billion, you certainly can't spend it, and you have to give it away, if nothing else, for tax purposes. So we'll keep an eye on how much they give away. But anyway, the Facebook, my best guess is they're going to come out with some blockbuster thing like a cure for cancer, or something like that, and it'll get the stock up anywhere from 12 to 20%, and it'll go crazy, just like we've done with Amazon, Netflix, Google. I mean, all of these have done that same type of thing, and because it's basically, I was listening to Tom's show before I started this morning, and they're basically 6 stocks, folks, that account for almost all the $119 billion in profits in the S&P 500 this year are basically done with 6 stocks. We have Amazon, Apple, Google, Gilead, Facebook, and Walt Disney. And Facebook is the only one that has not completed the patterns. It's got, and maybe this is not going to make the ABCD. I don't know. Maybe it's going to be something of a surprise. All I know is that it's got that ABCD structure in there in Facebook, and we'll be able to look at it. If you look at this chart, what's really interesting about it is if you bought the initial opening, the public offering, it went from 43 to 16. And then it made its bottom down at 16. It rallied up to 32, and then the best buy of all was when it made the retracement level at 61 or at $23 a share. It was making a 61% retracement, and it took 20 weeks to do that, and that was the time to buy it. And now it's gone 5 times the price of what we're looking at here. So people have a tendency to want to buy things in the emotional part of the minute, and that's as history says, that's not usually the best thing to do. See what's really happening. But I don't understand social networking. I really don't. I'm the worst of it. I did want to mention a real interesting comment about Amazon, and that is they are suggesting that they have drone zones now where they have people. They have a certain section where drones will fly to deliver the products that we're looking at. And then I happened to be listening to one of the people on one of the talk shows last night, and he was saying that the drones basically give terrorists a mini Air Force. They can literally, get a drone, hook a grenade to it, or some type of an explosive device, or whatever it happens to be, and have their own little mini Air Force. I don't know if anybody's ever thought of that, but that certainly makes a lot of sense. So some of this technology you got to be really careful with. So, well, we'll see what really happens. Now we have a situation in the markets where we have the Fed coming out today. That everybody knows. The FOMC is meeting today and tomorrow. They're going to be giving their 2 cents worth. Remember, two things I want you to remember. First of all, folks, commodities have been coming down for 18 months, and in the past month, they've accelerated a great deal. Copper, rubber, iron, corn, soybeans, oil, everything. I mean, all of them have been coming down. Gold, silver, and now we come in today where we have some more Fed news, and there might be enough news in there to push gold down another $10 or $15 down to that 1085 level, which I think will offer some pretty good buying opportunity. I still believe, the more I look at it, if we can get through this Fed meeting without the gold making new lows, that we have a chance for at least $150 to $200 rally in gold. And the reason I say that is the chart that I've posted in here, several times before. I'm going to do it again because I think it's important enough to take a look at, and that is the fact that they've got hedge funds are in their first net short position since they started doing information on hedge funds. So that goes back to 2001 when gold was at $260 an ounce. Now look what the hedge funds were doing in September of 2011. They were heavily long, and that was the wrong thing to do. So now they're down at the area. Hey, I'm going to talk about being wrong because I'm wrong a lot. That's one of my strengths is that I'm wrong a lot. But if you go back and look in 2007, in October of 2007, when Bernanke was talking to the folks and they asked him a question, he was on one of the Senate things that Yellen did this week, and he said he saw nothing in the economy that would see any problem with a turn down in the economy. I mean, they had no clue that there was anything wrong with the subprime market. I mean, this is the Federal Reserve. I mean, they got the inside information on everything, for heaven's sakes. So you got to remember that they're human just like me and everybody else, so they make mistakes. And remember that the main thing that they always talk about on the Fed, the young lady, Miss Yellen, she says they are very data dependent. And you know what they can do to data. They can massage that 20 different ways from Sunday. So just remember, but what they say and what they do can be totally different. And you've got to remember that the Fed is a big bank for big banks. They don't have your back. They never had, and they never will. So that's just my 2 cents worth. Now let's just talk about one of the things that I talked about last week, and that was a potential for a big drop in stocks into July 30th. And that doesn't look like it's going to happen because we've only got one more day till July 30th. The way you figure that out, folks, is you take the 29th of July and you add 1 day. That brings you to July 30th. Now, this is the pattern that I was looking at from 1987, where we crested on October the 2nd. We came down into October the 16th, and then we had the big drop on October the 19th, which was the best buying opportunity of the 1980s. So this pattern, even though we've dropped some, we certainly have, and we did gap down, but we went up and we almost filled the gap. The difference is, folks, if you look at your charts, and we're going to do that here very, very shortly, you'll see that the rally that we had yesterday from the bottom is nothing more so far than an ABCD pattern, a corrective ABCD pattern up to the 1290 level. And the NASDAQ went exactly to the 382 at 4570. So those are the 4470. So that's the main thing, that 4570, and so that's the main thing of what we're looking at in the NASDAQ. So we'll see if this is going to be anything. The Dow Jones couldn't even come close to the 382 retracement, and the New York Stock Exchange Index, you really can't use that until the market opens today, because it's not open overnight. When we had the rally overnight in the markets, and it's still continuing, and maybe it's going to go up, and maybe this is going to go up and make new highs. But boy, I'll tell you, there's a lot of selling coming into the market. We had a good advanced decline yesterday. We had about a 6-to-1 up stocks versus down stocks once the short covering rally started. And then you also had your new high to new low didn't increase very much yesterday. So there were not many new highs being made. So the thing is, today should be a relatively quiet day because they're waiting on the Fed to see what the Fed's going to do. But folks, they are going to raise interest rates. All you have to do is look at a bond chart, look at a note chart, look at a German bond chart, and you can see that these are in downtrends. They've been in downtrends, and their interest rates have been going higher in the market. It costs more to get a mortgage now than it did 2 months ago. So these rates are going higher. The question is whether we're going to see a spike in rates if in fact they do something crazy with the Fed, which crazy is not their thing. My guess is they'll raise maybe 25 basis points will be the first one in September, and then maybe 20 increments of 25 basis points. Folks, this is nothing like it was back when I was a stockbroker back in 79 and 80. Well, I was a stockbroker, but I only did commodities. I was registered in stocks, but the interest rates were running 13% in T-bills. You could buy tax-free muni bonds in California, AAA rated, for 18%. In other words, you got 18%, and if you were in a 50% tax bracket, you could imagine what you were making tax-free. The problem is, after 2 years, when the interest rates started to drop dramatically, which they've done for the last 32 years, those bonds were called, and they called them away from you because they didn't want to pay those interest rates, and you only got that interest rates for a couple of years. But during that time, it was certainly a good time to be in the tax-free muni bonds. And now you've got a situation where the whole world's got a lot of debt, and this is not a good thing, boys and girls. This is not a good thing. Going to take a little break here to pay a few bills. We'll be right back, and we're going to be talking about the notes and the bonds.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. news. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks. Before we get to the Treasury notes and Treasury bonds, I've had a request to take a look at Twitter. Yesterday, I was listening to Kevin from Thinkorswim talking about options, and gosh, it was one of the most interesting hours that I've spent. And it was, the guy really knows this stuff, and they were talking about Twitter and different option strategies. And of course, Twitter came out and it had some good earnings, and then I don't know what happened to it. I don't understand the fundamentals of what they were talking about. Twitter was trading at around 36 near the market close, and then the earnings came out, and the stock jumped to 10% up to 41, and then from there it went from 41 to 31. And so, that's one heck of a big drop, and of course it's near the end part of that zone. I don't know. They always have excuse for these things, and the excuse are the right things because that's what people are looking at. The question
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're looking for a great opportunity to diversify your financial portfolio, consider the Principal Protected Market Safe CD from Everbank. They've just released the second running of their 5-year Market Safe Power Metal CD, which combines the power of gold, silver, and copper. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your deposited principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Intrigued yet? The August 17th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and hopefully we'll be able to TFNN. Well, I mean, yours is okay, but I don't know, and I have no programs running. It still says I'm connected, but hey, hear me. Okay, I'm not sure whether. Anyway, we're taking a look at notes here, and this is the long-term weekly chart and notes, and as you can see, we made our top level. They got to 156 in the spot bond and didn't quite get to the 160 level, and now we sold off. We've been in a bear market for quite some time, and as you can see by this note chart, that it doesn't take much to turn this thing to the downside when interest rates will really start to spike, which will going to bring increased cost to some people. And of course they're having a break now because commodities are so cheap that this makes the products better, but unfortunately that doesn't always turn around and make it better example of that, of course, is Starbucks with the price of coffee. You know, coffee's made 7 years lows, and they would have to the consumer, but that is in fact, what did happen. Now, the next chart that I wanted to share with you, I showed you the note. I wanted to move across the pond over here to show you the German Bund. And as you can see, over the past several months, we've been going down. The chart with the bone move around quite a bit is, how they move these things in tandem. So we'll have to watch that, unfold. Far early this morning. So we'll see how this is going to unfold as we go through the day, and we'll look at it. The German market actually down on the day today. It couldn't do very much. We're going to take a little break in here, and we'll see what's happening with the markets at this time. Dow up about 30, S&P up 3, and NASDAQ up 11. I hope that's the break. I'm not sure. I'm losing contact, so we'll see. We'll see if that's the break or not. If not, I'll just keep on talking here. We'll see what's going on. Sorry, folks. I'm having some technical difficulty, and believe me, you don't want me music. You don't want me singing anything, because that's not the thing to be doing. So we'll wait and see. This will be interesting. What's going on over the Federal Reserve time. So we'll see that, what really happens with this. Anyway, we have the chart up of the German Bund, and that's basically, what we're watching, with this particular thing right now. Now, the New York Stock Exchange Index has not even come close to the 382 retracement of the whole move down since we made our high back on July 19th. And the other thing is that the NASDAQ just made the 382 last night on its big run up. So they could certainly, that doesn't mean they're going to stop at 382, of course, but that's just the first level that Steve Rhodes talked about yesterday when, he was talking about the different levels that we're looking at. But the New York Stock Exchange is the one that I watch, because that's the real stock market. It's not the S&P, because the S&P is so skewed now, folks. I mean, you're talking, like I mentioned before, you're talking 6 stocks, that make that thing go crazy. You got Apple, Amazon, Google, Gilead, Facebook, and Walt Disney. So, that's the bulk of the you got, probably 10, 15 stocks. In the S&P, and we already know in the NASDAQ you've got 10 stocks that control well over 50% of the market. So you're not getting a real picture of what's happening in the stock market by looking at those indices. And I think the picture's coming. It's just that it isn't coming yet. And it's not going to be a pretty picture. We've got record margin debt out there. And this debt problem is what the real problem is, folks. It's not the stock market. I don't believe the Fed is the least bit worried about the stock market. They're more worried about the debt market. And junk bonds have been, they've broken below the 786 on the downside, which is telling you that people don't want junk like they once did. They're no longer scrambling around for yield. So we'll see if that's going to be the case. case, we'll have to, do one thing at a time to see what's happening. But let's just take a look at this junk bond chart for just a second, because you'll see that, it's been breaking down quite a bit. And it's up a little bit today, and it's not too far away. We've got a huge ABCD here in junk bonds, very similar to that chart that we had in notes. But this is, you can see that we've weakened substantially to the Treasury bonds since we started this down move, way back in February. So we are below the 786 retracement in that. So it's telling us that we're most probably, heading down towards the area of 35, down another 8% minimum in the junk bonds. If we look at this on a long-term weekly, I think we'll be able to see, wow, we really haven't done anything. That's just truly amazing here, how the big run-up that we had in junk bonds. Oh, well, you don't get to see the whole thing. I don't have enough data in junk bonds because of the service that I don't trade these things, so it's not really not necessary to to take a look at it. But we'll do one thing at a time here. Okay, now let's get to the market that I think really has a chance for a monster move, folks, and nobody in the whole world thinks it can happen. And we're going to get to the we're going to get to it right now, and that is the gold market. I talked a little bit about that short covering that we had in the market, and I still believe whether we're going to make another low or not, I'm not sure. Today's going to be a real key day, because if we hold that 1085 to 1080 level and then turn, then we've got a really good chance. We haven't broken into new ground, but frankly, it hasn't moved up either. So that tells you that the cycle is probably, that's out there is probably still working. But the big ABCD patterns have been completed. We have a situation where the number of bulls versus the number of bears is as lopsided as it's been since 2001. That in itself should make one want to look at a place to get long gold, if nothing else. And folks, it's still a bear market, but you can get monster moves. From October through January, when we had a really bad bear market, when we went down to the 618 at 1130, the market rallied from 1130 to 1310. It rallied $18,000, $180 an ounce. And if we get a rally like that, that's just going to take us back to around 1220, and that's 130. So that's a $13,000 rally, and that's what you want to do. Is you want to trade in those things. You got to buy them when they're crying and sell them when they're yelling. That's what you got. Sell them when you're yelling. And who's our chairman of the Federal Reserve? It's Yellen. Maybe she'll be yelling today. Who knows? Anyway, we'll see how this gold, settles out. But it's got a real chance. I mean, I shouldn't get too excited about it, but it looks pretty good. We'll take a look here at the long-term weekly chart here on gold here, and because you can see that we've been coming down for well over a couple years now. But the market is just extremely oversold in the gold and also in silver. Now, remember that silver did not make a new low versus the gold. The silver actually held up above the market. Give me a second here, and we'll pull up silver, and you can see that silver is still held up above that 1410 level. That was our low from, way back last November. We've still held that, and silver is the same as gold. It still hasn't moved at all, and we're going to see if the market is going to make a bottom here. And of course, the Federal Reserve will probably have a great deal to say about the commodity prices. They'll probably give a comment that commodity prices are weakening, saying that's a sign of a possibly slowing economy. Whether that'll be the case or not, also, remains to be seen. So we have to watch that, relatively closely and see what's happening early this morning. Right now, we got the Dow up 32, S&P up 4, NASDAQ up 12. So the buyers are, continuing to come in, and they might take this thing up, make new highs in stocks, and if they do, more power to them. That's all you can do is to see what's going to happen. We're going to take a look now at the New York Stock Exchange Index, because that's the one we're going to do do it on an hourly basis here. So you can see we're just beginning to open here in some of these stocks. It takes about 15 minutes to get most of these stocks open now because they still do it the old-fashioned way there, and you'll be able to see the New York Stock Exchange Index, the big rally that we had. We had a double bottom down there that Steve Rhodes picked out so nicely, and now we're having the the continuation of the rally, but the New York Stock Exchange Index has not posted any new prices yet, so it's going to gap up. The question is, how much it's going to gap up, and then we'll see, what the 382 retracement is up about 2 or 3%, from where we are right now. So that's what it looks like on the hourly chart. And if we look at this on the daily chart, we still have a situation where we have a ABCD pattern that measures down at least another 3% from where we are right now. And this could be that maybe this is just a bad pattern and the double bottom is it, and the market's going to continue to run up to new highs. We'll have to wait and see. But the first trades have not posted yet on the New York Stock Exchange Index. So we'll see. That index is basically used for hedge funds, not hedge funds, for mutual funds and things like that, because that's what that's what it's there for. And it's the largest stocks in the world, the most highly capitalized and most active. There's 2,300 of them, I believe, and they're all cap weighted, as opposed to the Dow Jones, which is only price weighted. Okay, now we have a question about a stock, and that is, well, we're going to talk about Apple again, I guess. So hold on just a second here. We'll pull it up here, and we'll look at Apple and see what it's doing here. Okay, we'll put Apple up here. First of all, we'll look at it on an hourly basis, and right now it's trading at around 2309. And you'll see that we had a pretty good jump around with this thing here after the earnings came out in Apple. That surprised a whole lot of people. But we had a good rally yesterday. It got up to the 56.56% retracement. It couldn't quite make a 61% retracement, then it pulled back to a 61% retracement. So Apple is still in a really tight trading range that is bounded by the 786 retracement, because if we look at the daily chart in Apple, you'll be able to see the 786 was the absolute low that we hit 5 days ago after the earnings. The earnings came down, stopped there, they rallied up about $6 a share, and now we're setting in around the 122. When we get below 121.5 in Apple, then there's going to be a lot more movement to the downside, because then you'll start to see that you've got the prices going. We had a little bit of selling here in the first few minutes. The NASDAQ is backed off from 12 up to 5 up. The S&P still backed off a little bit, and Dow is still up about 40. So we got as my good friend Basil Chapman would say, we have a bifurcated market. There's two different ways of looking at this puppy, and that's pretty much it. Folks, I've been doing this for a very, very long time, and I get a lot of different bits and pieces of information. But when you see that about 25 stocks of the S&P, the Dow Jones, and the NASDAQ, and you could actually say less than that. You could probably say 10 or 15. 10. You could say 10 stocks in that group is basically, pushing the market. That is not a bad thing, or not a good thing, folks. And that is because it's hiding the underlying weakness that's in the market, because there is a great deal of selling coming into these things. You've got dropping commodity prices. That's not a good thing. And something is just not right. But when you add to that two things. One is the fact that you've got record margin debt that we've not had since 2007. And the second thing is that you have the lowest volatility that we've had in 3 of the last major peaks, 2000, 2007, and 2015. So those are the things that bring you to the forefront of saying you've got to be extremely careful in here. And believe me, when this thing starts down, folks, it's not going to take any prisoners. They didn't take any prisoners in China. They didn't take him in Hong Kong. They didn't take him in 07 and 08. They didn't take him in 2000, and they're not going to take him here either, because nothing ever changes. There's nothing new under the sun. This is just another pattern that's happening, so see what's happening, with these things. And, we'll see what, oh boy. I unfortunately, when you're here at TFNN, you get to listen to the people that are in the Tiger Den, and there's some really smart folks in there, and some of them have a tremendous sense of humor, and they post something into the room, and I happen to see it, and it makes me laugh, but I cannot repeat it on the air, as they say in the trade. So we'll go on to the next topic here. Okay. Someone asked a question about Facebook. I've already covered that, and that is, Facebook is trading around 95 and change, and the ABCD structure on Facebook takes it, if it gaps up today, which I expect it will do, 12% would take it up to the 110 level, and that's pretty much what the ABCD structure is, on this. So whether we'll see it or not, I don't know. All I know is the major ABCD patterns in the NASDAQ, and all those 1.618 expansions finished up at the 156, at 40, the 4680, 4690 level, back about 10 days ago. And the market has broken down, and we've had a pretty good bounce yesterday and today. We rallied up to the 38% retracement, and we'll see if the market has the ability to go up to the 61% retracement, which would be at 2100 in the S&P, and it would be quite a bit higher. It'd be about 70 points higher in the NASDAQ. So it's going to, and it could certainly do this, because the people that have bought this over a period of time have made a great deal of money by buying the breaks. And believe me, I've been there and done that. 1974. I got to tell you this, because you folks, a lot of you guys are new traders, and some of you made some money, some of you have lost some money. But when I started this, I didn't know how to sell short. I mean, that never entered into the picture until I understood what the heck it meant, because I basically bought cycle lows during 1966 through 1974, and I bought all those cycle lows, and every one of them worked, and I was making a lot of money. The problem was when the cycle low became quickly, in other words, it would bottom on the 10th of July, rally up to the 20th of July, and then come down and go below that low of July 10th. That was a thing called high translation that meant that the trend was sharply lower. This I didn't understand for 18 months later, after I'd lost all my money, because it was really a good deal. When prices go down, it's a good buy. It's a good buy house, good buy car, good buy boat, good buy jewelry, good buy wife. It's only a good buy is only so much that a person can look at. So be really careful in here. This market's gone up forever, 6 years, and but boy, it's sure got some things that are making it look like it's on quicksand. But we'll have to wait and see if that in fact is going to be the case or not. Now I need to show the chart of the Treasury bonds here, because that was one we missed, and I really want to show you that, because the bonds did make a ABCD structure, whereas the notes did not, and that in itself was a
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back, folks, and we're going to take a look at Treasury bonds here. You can see the daily chart that I've posted into TFNN, making a beautiful ABCD structure. It's just about as perfectly symmetrical as you can possibly get. And it's indicating that you want to be short bonds in this area. Now, that might change with the Federal Reserve coming out today, but this is what it looks like, what it appears. Now, in order to really to take advantage of this, we needed to go to a weekly chart, much like we did with the Treasury notes, because if we do that, you'll be able to see the larger structure that's out here that will show you that you're looking at a price objective down about 10%. So we're going to be looking at some pretty steep interest rate things coming in into the picture, it looks like, from this bond chart. And unless the market explodes above the 156 level, and that would probably mean that this is not a correct chart. But it had 3 weeks up both times. Each of the legs were perfect in both price and time, so that 156 level should be some pretty steep resistance in the market. So that's basically the bottom line of what we're watching here. So we'll just keep an eye on that. Now, the other one is gold. We're trading now at 1090. The 61% retracement of this last move comes in at 1085, and with the Fed coming out today, all bets are off of what's going to happen. But I have to be looking at this from the long side just because of the fact that you've got all of these folks from the hedge fund community are net short now. If you follow the CFTC report that we posted in here, you'll notice that the main selling happened when gold broke below the 1130 level down to the 1070 level. That's $60, and now we're trading at 1090, so we're in the mid range of that. And the 61 comes in at 1085, so we'll watch that. But you've got everybody lopsided in that market, so it's really ripe for a monster short covering rally. So live every day in an attitude of gratitude, and please do something nice for someone who has a lot less than you.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.